Well, we are seeing record and near record highs in the markets. Always good news for a lot of people, but also it raises some questions, some concerns as well. So let's bring in Sam Stovall. He is the chief investment strategist at CFRA Research. And Sam, thanks very much for joining us.
Happy to be here, Roger.
A lot of people are happy right now. You're keeping an eye on some things, though, and the big concern for you right now looks like is valuations.
Yeah, I'm just a little bit concerned that there's a bit too much euphoria around right now. When I look at the current PE ratios on forward estimates for not only the S&P 500, but in particular for the technology stocks, I see that the S&P is trading at a 45% premium to its 20-year average forward PE, and that tech stocks are trading at a 70% premium. Now, of course, you could say, well, you shouldn't really be looking at a 20-year PE ratio because AI really has dominated the conversation only in the past 10 years, even 5 years. And if you're looking at it from that perspective, well, then the premium is only 17% for the S&P 500 and 22% for technology. So I wouldn't be surprised if maybe we end up waiting until the beginning of the new year when people want to take their tax consequence, delay that for a while. But I do think that we are due for some sort of digestion of gains.
What would you like to see for some of those premiums? What would leave you more comfortable?
Well, I think because there is a lot to be said about AI driving the marketplace, et cetera, the implication would be that we end up with a decline of 5 to 10%. What is interesting is that since World War II, whenever you have had a correction, a decline of 10 to 20% occur in the beginning of the year, that we typically don't have anything beyond a 10% decline if that were to start in the same calendar year. So I would tend to say that the digestion would be fairly reasonable, with the average being around 8.5%.
So where are you looking right now then? I know we're talking defensive, so what do you have your eye on? What sectors?
Well, one area that you can look for in terms of defensiveness is when you say, well, what about dividend yield? Does that imply a bit of defensiveness? And the answer is yes. If you break the S&P 500 into quintiles, those companies with the highest dividend yield, they end up having the lowest beta of 0.83 versus 1.31 for those with no dividend. So meaning that the volatility is 30% higher for the companies on average that do not pay a dividend versus a 17% lower volatility for companies that pay higher dividends. And ditto is for the forward valuations, 18.8 for those higher yielding companies, but 34.5 for those lower yielding companies. Sectors that have nice dividend yields are energy, real estate, and utilities, as well as some of the other defensive areas that we're all familiar with, such as healthcare and consumer staples.
And within those, what are you looking for within those sectors that make you want to stay with those companies or stay with that sector?
Sure. Well, what I did was I leveraged the CFRA equity analysts, and I said, show me those stocks that are ranked buy or strong buy, that are paying an attractive dividend yield in excess of 3%. However, their payout ratio, meaning what is the percent of the dividend paid out versus the earnings, is less than 75%. So you didn't just get a whole bunch of really stodgy companies out there. You got companies like Comcast in the communication services area, EOG Resources, as well as Mobile Corporation in energy. You also got Merck in the pharmaceutical or healthcare category. So a variety of companies from at least half of the sectors that are found in the S&P 500.
And is there a common theme between those companies that gives those solid numbers for you?
I think it is the quality and consistency of raising earnings and dividend over an extended period of time. I guess you could say those are the companies that are referred to as dividend aristocrats, where pretty much you can count on them to raise their earnings and dividends because they have a pretty solid position within their industry or sector. They have a fairly wide and deep moat, and so as a result, they do consistently increase their earnings and dividends, as well as therefore reduce their overall volatility.
And what's the quintile you're staying away from? What are some of the companies or sectors you're seeing that aren't making you smile?
Well, I would say right now we do have some challenges in the materials category. They're starting to show a little bit of life, but we are a bit concerned about that. I do think that we are looking at valuations that are a bit stretched in specific areas of, let's say, consumer discretionary. And actually, even though real estate historically has been a fairly good provider of dividend yields and lower volatility, we do have that sector ranked as an underweight at this point.
And is that concerns over tariffs and bank rates?
I would tend to say that, yeah, there are still some concerns over tariffs, in particular, a lot of the consumer discretionary areas that are being affected by tariffs, with still trade disruptions between the U.S. and China. And so basically, the focus is on those companies that our analysts feel are best positioned and really are not likely to be affected too much by the tariffs.
Okay, Sam, thanks as always for joining us.
My pleasure.
Sam Stovall is Chief Investment Strategist at CFRA Research.